Welcome back to your Mortgage Insider Update for this week. We've got a quick look at the charts. Interest rates have improved after the Consumer Price Index and the Producer Price Index reports came out last week. They were not as bad as could have been expected. A lot of revisions, meaning that prior months, higher inflation numbers in previous months, like in March, were actually reduced back down. So they were overstated in there when they initially came out. And we're going to take a look back and see what that did over the last month to our charts. Today we're going to start at the 10-year Treasury, down 3 basis points, well below 4.5% at 4.41. Battling a little bit of the averages, so to speak. So these are the 50-day average currently. We've trended well back down since April 24th in anticipation prior to the CPI report and the Producer Price Index report last week. We had a pullback, huge improvement. We've since come back a little bit, and we're hovering in this area. Looking for some better information to come out. There's a lot of international things going on right now. What is the feeling on the future of inflation, oil prices, which are actually down this week slightly, in the midst of unrest and challenges going on in the Middle East. So as those pressures apply, we can take a look back just from the month of April. Wow, how those interest rates climbed and fell. And, we go through these trends over time, but we are really hoping to get back into levels that we had back in the beginning part of the year. That was a very good driver for activities, buyer activity in the marketplace. So a little bit of relief and a little bit of good news can go a long way. Quickly, we look at the mortgage-backed security. This is the inverse. The mortgage-backed security prices will rise as the interest rate to the consumer falls. So we can see the spike and high point in the prices back on the 16th, just after those reports came out. We settled back in. And we're looking for a catalyst in the next week to bring us back into a more reasonable level of rates, get below 7%, get in those mid sixes would be really great. And if we can get there this summer as the inflation reports roll out. And unfortunately, we're going to have to watch the next jobs report for the first indicator that'll come out the first Friday in June to see if the jobs market has slowed any further as it did back last month in April. Have yourself a great week.